April was historic. The S&P 500 just put up its best single month since November of 2020, over 10% in 1 month. So now everybody's asking the same question. Do we keep riding this into summer? Or is the old Wall Street saying about to hit us? Sell in May and go away. Dating back to the 1950s, May through October has been the weakest stretch of the calendar for stocks, every single year. But here's what makes 2026 different. The market is being driven by something we have never seen at this scale, AI infrastructure spending. And if you want to see proof, look at the best performing S&P 500 stocks this year. SanDisk up 400%, Intel up 172, Seagate up 165, Western Digital up 150, every single one of them tied directly to the AI build-out in 4 months. That is not normal. Now, I'm not here to tell you to chase those names. That train has left the station. What I am here to do is give you 5 stocks that represent real opportunity right now at today's prices across 5 completely different themes: growth, commodities, cybersecurity, income, and space. Each pick is distinct because a good portfolio isn't built on one idea. It's built on smart diversification. And if you're serious about building real wealth in this market, do me a quick favor. Hit that subscribe button right now. We drop fresh breakdowns every single week and you do not want to miss what's coming. All right, let's get into it. Stock number 1 is a name that has been absolutely beaten up, and I think the selling is completely overdone. That name is Spotify. Ticker SPOT. I know what you're thinking. Didn't AI just blow up their entire business model? That's exactly what the market thinks, and that's exactly why there's an opportunity here. For years, the knock on Spotify was simple: no profitability, high content costs, no pricing power. That story has completely flipped. Margin expansion is real. Operating leverage is showing up in the numbers, and the company is now generating actual earnings, not someday earnings, not theoretical earnings, real ones. Now, AI music is a real concern. Artists are fighting back. Taylor Swift, and yes, I never thought I'd say her name in one of these videos. She recently filed a series of trademarks specifically to protect herself from AI-generated impersonations. And Spotify itself pulled down more than 75 million AI-generated fake tracks last year alone. They are not sitting back and letting this happen. But here's the bigger point. If AI music truly takes over, that is an existential threat to the entire music industry, not just Spotify. The platform is a distribution channel. It benefits from content volume. If anything, more content means more engagement, more listening hours, more ad impressions. And Spotify is leaning into AI themselves, the AI DJ feature. More personalized recommendations. Better ad targeting. This is the same playbook Google ran, the same one Amazon ran. Meta ran it too. And those stocks are at all-time highs. Now the numbers. Monthly active users keep growing, both the free ad-supported tier and the premium tier. Revenues are still climbing. Earnings are expected to grow roughly 22% annually over the next 2 years. And yet, shares have fallen more than 25%. At today's price, you're picking up Spotify at just 29.7 times forward earnings. That's a PEG ratio of about 1.3. For a company growing at 22%, that is genuinely cheap. This stock was trading at 40 to 70 times earnings just 2 years ago. You're getting it at under 30. Analysts have a 12-month average price target of $600. That's more than 35% upside from current levels. This is a product I use every single week. The fundamentals are improving. The valuation is compressed. And the AI narrative that crushed this stock is, in my view, completely overblown. I'm looking for a bounce in May and beyond. Quick pause. Which stock are you most interested in so far? Drop it in the comments. I read every single one. And if you're finding value in this breakdown, smash that like button. It takes 2 seconds, and it genuinely helps the channel. Let's shift gears completely, because this next pick isn't about tech. It isn't about software. It isn't about AI directly. But it is about the one material that makes the entire AI build-out physically possible: copper. And the best way to play copper right now is Freeport-McMoRan, ticker FCX. Here's why copper matters more than ever. Every data center, every EV charging station, every power grid upgrade, all of it runs on copper. The AI infrastructure driving this market cannot be built without it. Demand is structurally high and supply is constrained. That imbalance does not resolve quickly. Freeport has a market cap of $83 billion. Over the past 12 months, shares are up 55%, which tells you institutional money has been piling in. But in the past week and a half alone, shares pulled back close to 20%. Why? 2 reasons. First, their latest earnings showed continued impacts from a mine tragedy in Indonesia that forced them to cut production targets for the year. That's real. That's a near-term headwind. I'm not going to pretend otherwise. But here's the key. Management has been clear. 2026 is expected to be the bottom for that mine. Production comes back in 2027 and keeps growing from there. If you buy today, you're buying the bottom of that operational cycle, not the top. Second, they've been modeling their cash flow and EBITDA based on copper at $5 a pound. Right now, copper is trading at $6 a pound. That's a meaningful gap. If prices stay anywhere near current levels, their numbers will beat their own guidance. That is a setup I like. Shares trade at just 22 times forward earnings. Earnings are expected to grow more than 40% per year for each of the next 2 years. If you have zero exposure to commodities and zero exposure to real assets right now, that's a risk in this environment. FCX gives you copper exposure, AI infrastructure tailwinds, and a discounted entry point all in one. Now let's talk about the most frustrating trend in today's market. And I don't say that lightly. Every time a new AI coding tool drops, the market sells off every single cybersecurity stock, every single time. Scalar, ticker, ZS, down nearly 40% over the past 12 months, almost all of that in 2026 alone. And I'm going to tell you something that might sound obvious once I say it, but apparently the market hasn't figured it out yet. AI coding tools do not replace enterprise cybersecurity, not even close. Here's what I mean. These tools are excellent at pre-deployment code scanning. That's a niche called static application security testing. They catch vulnerabilities before code ships. Great, genuinely useful. But that addresses one small slice of security. It does nothing for network traffic monitoring, real-time threat detection, zero trust access control, data loss prevention, the thousands of enterprise security use cases that Scalar is built for. Enterprise security is not optional. It is a requirement. People did this same panic sell with Google when AI launched. I was buying. They did it with Nvidia when the stock dropped to 160. I was buying. They did it with Amazon. I was buying. Now the same irrational fear is hammering cybersecurity, and Zscaler is the clearest name in the space. This is the cheapest you've been able to buy ZS on an earnings basis in years. Analysts have an average 12-month price target of $228 per share. That implies more than 60% upside from here. Cyber stocks right now are not trading on fundamentals. They are trading on fear. And when great companies trade on fear, that's when you buy. Are you holding any cybersecurity names right now? Drop it in the comments. And if someone in your circle keeps asking about AI and investing, share this video with them. It could genuinely change how they think about it. All right, everything we've talked about so far has been growth-oriented. Tech, commodities, cybersecurity. Now let's talk about the person in the room who wants income, stability, and something that doesn't move every time Nvidia sneezes. That stock is VC Properties, ticker VC. VC is a REIT, a real estate investment trust. And not just any REIT. VC is the largest landlord on the Las Vegas Strip. Think about that for a second. They own the real estate under Caesar's Palace, MGM Grand, the Venetian, Mandalay Bay, New York, and more. These aren't just casinos. These are some of the most visited, most resilient hospitality assets on the planet. The structure here is critical. Long-duration leases, inflation-protected escalators built right in, and a tenant base that is not going anywhere. These are the largest gaming operators in the world. During the pandemic, when almost every REIT was cutting dividends and watching tenants stop paying rent, VC collected 100% of rent due, every single dollar. That tells you everything you need to know about the quality of their tenants. Now the valuation. For REITs, we focus on FFO, funds from operations. Think of it like operating income. VC's FFO has grown every single year since they went public. They recently crossed $3 billion in annual FFO. Here's the opportunity. Historically, VC has traded at an average price to FFO of 11.6 times. Today you can buy it at 9.7 times, under 10 times FFO. That is historically cheap for this name. And while you wait for the valuation to normalize, you collect a 6.2% dividend yield. With a 5-year dividend growth rate of 7%, 7 consecutive years of dividend increases. Real estate has been the worst performing sector in the S&P 500 for the past couple of years. That underperformance creates value. If you want income, a cheap valuation, and real assets backing your investment, VC is the answer. And now the high-risk, high-reward name. But I'm going to approach it differently than the others. Rocket Lab, ticker RKLB. I brought this stock to your attention last year in a video covering 3 stocks that could double your money. 2 of those picks were AMD and Rocket Lab. AMD is up over 100% since that video. Rocket Lab is up nearly 80%, faster than even I expected. Do I still like the stock long term? Absolutely. Rocket Lab is building the infrastructure for the space economy, launch capabilities, satellite systems, the full stack. And if you think space is still niche, consider this. SpaceX is positioning for what could be the largest IPO in history later this year. The space economy is not a future thing. It is a right now thing. But here's the thing. After that run, I don't want to just buy shares at $79. Technically, the chart is giving me pause. The 50-day moving average just crossed below the 100-day. That is a bearish signal. The MACD has crossed below as well. Both of those tell me there could be more downside before the next leg up. I want to buy closer to $60. Near the 200-day moving average, which has been a key support level for this stock multiple times. So here's what I'm doing instead of just waiting around. I'm looking at selling the $60 put expiring June 18th. That's roughly 45 days out. That trade generates about $240 in income per contract right now. What does that mean in plain English? You get paid $240 up front. If the stock stays above 60 by June 18th, you keep the premium. Done. If it falls below 60, you're obligated to buy shares at a price you already said you wanted, with your cost basis reduced by the premium you already collected. It's called a cash-secured put, and it lets you get paid to wait for your price. If you want to learn how to use options like this, I'm hosting a 2-day live workshop this week, Wednesday and Thursday, 7 p.m. Eastern. Link is in the description below. Let's step back and look at the full picture. 5 stocks, 5 completely different themes. Spotify, improving fundamentals, depressed valuation, AI fears overblown, Freeport-McMoRan, copper demand isn't slowing, near-term headwinds are priced in, and the 2027 setup looks strong. Scalar, the most irrationally beaten-down name on this list. Great business, terrible sentiment. That's the combination you want when you're buying. VC properties, income, stability, cheap valuation, real assets. The ballast in this portfolio. And Rocket Lab, long-term space economy play, but we're being smart about entry, using options to generate income while we wait for our price. Different angles, same goal. Positioning for what's next, not chasing what already happened. If you want to follow all 5 of these in real time, full portfolio, option alerts, live trade breakdowns, join the Stock Investors Edge community. Link is in the description. If you found value today, hit that like button. Subscribe so you don't miss the next one. And share this with one person who you think needs to hear it. That's it for today. We'll see you in the next one. Take care.